Something just went down in the silver market that you need to understand right now. The price you're seeing flash on your trading screen and the actual price being paid in real physical cash markets are drifting dangerously apart from each other. And if that gap keeps widening at this pace, we're staring directly at the critical moment when silver futures contracts get settled with cash instead of metal. Because the physical metal simply isn't there to deliver anymore. That's the triggering event we're watching for. That's what changes everything overnight. And if it actually happens, it won't stay contained inside the silver market. Because once one supposedly guaranteed promise can't perform as advertised, every other financial promise in the system starts to look extremely suspicious to everyone watching. This is Market Pulse USA, and today we're connecting 4 major threads that most analysts keep completely separate. The silver delivery risk that's building pressure, the massive derivatives mountain sitting on top of the real economy, the carry trade unwind draining liquidity from global markets, and the slow motion retreat from US debt that's quietly forcing the money printing press back into the driver's seat. As we break this down, I want you to notice something critical. Every single one of these stories is really the exact same story underneath. It's the story of confidence collapsing in the financial system. Now, quick request, before we dive deeper into the data, I'm actively running a campaign to completely eliminate copycat channels that steal original work, remix it poorly, and then somehow outrank the actual source in search results. If you genuinely value the way Market Pulse USA breaks complex situations down into clear analysis, smash that subscribe button right now. Drop a comment saying Market Pulse USA so the algorithm clearly knows who's actually here for real original content and research. Also, make sure you're subscribed and have notifications on because in our next video, we're going to guide you through exactly what to watch for as this situation develops. Market Pulse USA delivers all our analysis through video content right here on YouTube, so you won't miss critical updates when markets start moving fast. All right, now let's start with exactly what happened behind the scenes recently. Silver didn't just casually rise over the past few months like a normal bull market. It moved like a market that finally woke up and realized it was severely mispriced for years. But the headline number on your chart is not what matters most here at all. What actually matters is the way the market behaved during the entire move higher. Because if you look beneath the surface chart action, you see something far more important than just a rally. You see structural stress building in the system. The traditional paper futures venue still desperately tried to control the price narrative by printing a number that assumes physical supply is basically infinite, because paper contract supply basically is infinite with a few keystrokes. Meanwhile, physical cash and carry markets where real people actually show up with currency and expect immediate delivery started trading at noticeably higher price levels consistently. And once you have 2 distinctly different prices for one identical metal, the entire game changes instantly. Because the next logical question becomes completely unavoidable for everyone. Which price is actually real? Is the real price the one that can be easily pushed around by paper contracts that can be created with a keystroke? Or is the real price the one where a buyer can hand over hard cash and physically demand metal bars in return? This is exactly why I keep telling you the story is fundamentally shifting from watching charts to understanding mechanics. Price suppression through paper markets is definitely not new at all. But suppression only works effectively while the crowd believes paper contracts and physical metal are perfectly interchangeable. The exact moment that belief cracks even slightly, the system doesn't just face normal volatility, it faces a brutal credibility test from the entire market. And the credibility test has a very simple pass or fail question attached. Can the contract actually perform what it promises? Because here's a brutal truth nobody wants to say out loud. A contract that can't deliver what it says it will is not just a discounted asset trading cheap. It's a broken promise wrapped in legal paper. And broken promises don't get neatly contained to one market. They spread like wildfire through connected systems. Let me paint you a simple picture of how this situation usually plays out and why the next major delivery window matters so much. Most casual observers don't realize that futures markets have very specific months where delivery pressure naturally concentrates. You can trade contracts all year long without issues. But when a big delivery month arrives on the calendar, the entire conversation changes instantly. From what's the current price to show me the actual metal right now. That's when short sellers who normally just roll their positions forward into the next month suddenly have a serious problem. Because rolling only works smoothly if the other side agrees to keep playing the paper game indefinitely. But if enough sophisticated buyers stand firm for physical delivery, the short side faces a crisis. They have to either find physical bars somewhere, or borrow them from someone at a cost, or pay a substantial premium to source them from tight markets, or negotiate a cash settlement instead of metal. And that's exactly why you'll often hear experienced traders point to spring delivery windows like March or April as potential stress points, not because someone is randomly guessing dates, because that's when the machine has to actually prove it can do what it claims. Now imagine the mainstream headline appearing. Exchange announces alternative settlement procedures due to market conditions. It will sound completely harmless to most people. It will be wrapped in complex legal language and technical jargon. It will be blamed on temporary logistics issues or market disruption beyond their control. And the first wave of the uninformed public will just shrug casually. Because cash settlement sounds perfectly normal if you don't understand what you are actually buying. But the professionals trading these markets will hear something very different in that announcement. They will hear the physical metal wasn't actually there. And the exact moment that becomes the whispered truth on trading desks everywhere, the entire conversation around paper commodity markets changes forever. Because commodity derivatives don't exist in complete isolation from everything else. They are used as collateral in larger trades. They are hedges, protecting other positions. They sit inside complex portfolios that also hold stocks, bonds, credit instruments, and currency positions. So if one piece of the derivative universe suddenly loses credibility, margin requirements change everywhere simultaneously. And margin calls are where panic actually lives in markets. When confidence cracks, exchanges and brokers immediately demand more collateral from everyone. When they demand more collateral, leveraged players have to raise cash extremely fast. And when they have to raise cash fast, they sell whatever they can liquidate, not whatever they want to sell strategically. That's exactly how a problem originating in silver can force panic selling in tech stocks, junk bonds, and even supposedly safe government debt. It's not because those assets are directly related to silver fundamentally. It's because they're all connected through the web of leverage. This is why I keep saying the reset doesn't start where you expect it to. It starts where the system is structurally weakest. Now, one more critical layer, because this is the part most people completely miss. The biggest slice of the entire derivatives world isn't even commodities at all. It's interest rates and bonds. Interest rate swaps, futures, options, and structured products represent a huge portion of the entire pile. That means when bond yields move violently in either direction, the derivative machine starts groaning under pressure. And that brings us right back to the carry trade and to Japan. When long-term yields climb after decades of near zero policy rates, the pressure is not linear at all. A small rise in yield can create a massive loss in bond price, and in leverage trades, small losses become forced liquidations immediately. So when you see yields spike suddenly, it isn't just another headline. It can be a signal that the cheap money era is finally snapping. And if the cheap money era snaps at the same time that a commodity delivery system is being questioned, you get a double shock hitting simultaneously. Funding stress and trust stress, that's the exact kind of toxic mix that turns normal markets into historic events. Now you might be thinking, but the system has survived so many scares before. Absolutely true. And that's because it usually has one thing left to deploy: confidence theater. They tell you everything is fine. They tell you supply is adequate. They tell you the market is orderly. And as long as most people believe it, it stays orderly. But confidence theater only works until it collides with a hard physical constraint. And physical shortages are hard constraints. You can't print metal bars. You can't talk your way into inventory. You can't create silver with a press conference. So the moment physical reality contradicts paper promises, the narrative loses all power. Now let's zoom into the strategic angle again, because this is where retail investors get completely blindsided. If you're buying silver as a store of value, you're thinking like a saver protecting wealth. But the largest buyers are thinking like operators running businesses. They're thinking if we don't secure supply, our production line stalls. And a stalled production line is infinitely more expensive than paying a premium for metal. So strategic buyers will pay up. They'll pay up quietly. They'll pay up through contracts you'll never see publicly. And that's how the retail market can be drained without any dramatic moment on the chart. A lot of people learned this lesson in other markets. When energy is tight, consumers don't get first priority. When food supply is tight, export rules change. When a material becomes critical, governments don't hold a vote to ask permission. They act. So if silver is viewed as critical, the great lockout isn't science fiction. It's a policy pathway. And what makes it dangerous is timing. It can happen fast with no warning, because it only takes a few large decisions to redirect flow. Now I want to throw in a viewer-style question here, because I know it's in your head. A lot of you are asking, if the paper system breaks, will the price crash first? And the honest answer is, you can see violent moves in both directions. In the early phase of a crisis, forced selling can hit everything, even metals, because people sell what they can to meet margin. And that can create sharp dips that feel like the thesis is wrong. But if the crisis is rooted in trust and scarcity, those dips can be the last chance to get real metal. Before the door closes, that's why the psychology is so brutal. The market tries to shake you out right before the fundamentals take over. Now think about the bond market math for a second. Debt grows every single day. Deficits persist. Auctions continue. If marginal foreign demand falls, then domestic demand must rise. If domestic demand can't rise enough at current yields, yields must rise to attract buyers. If yields rise too far, the interest burden grows. And when the interest burden grows, the political temptation to suppress yields grows. That's the trap. Suppress yields and you risk the currency. Let yields rise and you risk the system. Either way, hard assets look more attractive. Now this is the part that gets people arguing about hyperinflation versus deflation. And I'm going to say it the way it actually plays out. You can have both. You can have currency inflation at the same time as asset deflation. You can have prices rising at the grocery store while asset bubbles pop. It depends on what is being deleveraged and what is being printed. And the measuring stick matters. If you measure in dollars, you see one story. If you measure in gold or silver, you see another. That's why some people are shocked when they price big ticket items in ounces instead of in currency. They realize the expensive world is sometimes a currency illusion. Now let's talk about the human side again, because charts don't capture what matters most. If you're living in a fragile system, your best investment is optionality. Optionality means you can adapt when conditions change. And optionality isn't just money, it's skills, it's relationships, it's stored essentials. It's the ability to say, I don't need the system tomorrow. Because the system gets dangerous when it can't meet needs. That's why I talk about basics. If the grid is unstable, can you keep light? If water is compromised, can you filter it? If transport is disrupted, do you have a buffer? If you lose income temporarily, do you have runway? This isn't doom talk. This is adult planning. And the people who plan in calm times don't panic in stress times. Now let me weave the miners back in, because there's another angle people don't consider. In a true resource repricing, governments can get involved. They can change taxes, they can change royalties, they can change rules, they can declare resources strategic. So when you own a miner, you're not just owning geology, you're owning jurisdiction risk too. That's why diversification matters. That's why position sizing matters. And that's why holding at least some physical outside the system matters. Because physical doesn't need permission to exist. Now, one more community moment, and then we're going to land the plane. If you've had success in the past year, whether it's in business, investing, or just getting your life in order, drop a short note in the comments. Tell people what worked for you. The comment section can be a place where we build each other up, not just a place where we argue. And if you're still watching right now, that tells me you care about understanding what's happening, not just being entertained. So do me one more favor. Make sure you're subscribed to Market Pulse USA. Because the next phase of this story won't give you a polite warning. It will hit fast, and we'll guide you through it in our upcoming videos. Now let's return to that final cliffhanger. And I want you to feel the weight of it. If silver delivery fails and cash settlement becomes the precedent, the world learns that paper is optional. And once paper is optional, the only thing that isn't optional is the real thing. So the question isn't whether silver is up or down tomorrow. The question is when the system is forced to choose. Do they protect the paper market's reputation, or do they protect the real economy's access to strategic metal? Because whichever side they choose, the other side will react. And that reaction is where the real repricing begins. Let me bring it back to the beginning again, because this is the part you should keep in your head, while everyone else gets distracted by noise. If a contract says, deliver silver, and instead you get cash, then you didn't buy silver, you bought an IOU, and if the IOU gets paid back in a different form than promised, everyone starts asking, what exactly am I holding? That's why delivery matters more than price. Now, the reason silver is such a dangerous pressure point is because silver sits in two worlds at the same time. It's a monetary metal, which means it competes with confidence in currency. But it's also an industrial metal, which means it competes with the physical needs of the real economy. That's the trap for the paper system. Gold can be hoarded and recirculated because much of it is still above ground in bars and jewelry. Silver gets consumed. Silver gets dispersed. Silver gets lost in tiny amounts across products. And those amounts add up. So when demand tightens, silver doesn't have a huge above-ground pile. That can magically refill the shelves. That's why in silver, the physical side can overpower the paper side without needing a miracle. Now, some people still say, okay, but who cares? It's just silver. And I want you to remember this line. In modern finance, it's never just one market, because silver sits inside the derivatives machine. And the derivatives machine is the real monster here. Most people think derivatives are some side casino, a playground for professionals with 6 monitors. But derivatives are not the sideshow in a financialized world. Derivatives are the operating system. They wrap around interest rates, currencies, credit, commodities, equities, and even volatility itself. They are the plumbing. And here's the part that should make you sit up straight. The size of that plumbing, even in conservative terms, is multiple times larger than the value of the real assets it's supposed to reference, meaning we've built an enormous structure of promises on top of a smaller pile of real stuff. That's the tail wagging the dog It's like writing insurance policies on a house, then writing insurance policies on the insurance policies, then writing bets on whether those policies will be paid. Everything looks stable until one claim can't be honored. And the moment one claim can't be honored, everyone rushes to check the fine print on their own claim. This is why one delivery failure can ripple outward, because it's not the metal. It's the trust. If silver is cash settled due to emergency conditions, or some version of force majeure, the market learns something dangerous. Performance is optional. And if performance is optional in silver, traders won't stop at silver. They will start asking, is gold next? Then is copper next? Then is energy next? Then is food next? And the second that question becomes mainstream, risk gets repriced everywhere. Now here's the part I want you to really think about. When trust breaks, it doesn't break smoothly, it breaks all at once. Because trust isn't a dial, it's a light switch. You believe the system works until you don't. And in that moment, people stop chasing returns and start chasing certainty. They start chasing collateral. They start chasing anything that can't be created in unlimited quantities. Now, if that's the first thread, here's the second one. And it's happening at the same time. The carry trade unwind for years. One of the easiest global trades was borrowing in a currency with extremely low interest rates and deploying that money into higher yielding assets elsewhere. When funding costs are near zero, leverage looks harmless. But when rates rise, leverage turns into a trap. And when that trap snaps, it doesn't just hurt one fund. It pulls liquidity out of everything. Because that borrowed capital didn't sit idle. It flowed into government bonds. It flowed into corporate credit. It flowed into equities. It flowed into risk. And in some cases, it flowed into strategies that leaned on commodities through paper selling. So what happens when the unwind accelerates? It does two things at once. It removes support from traditional assets because positions that were propped up by cheap borrowing have to be reduced. That means selling. And it forces closure of certain short positions because those positions become too expensive to carry or too risky to maintain. That means buying. This is why the unwind can be chaotic. One side of the market is being liquidated, another side is being squeezed. And those forces don't cancel out, they collide. Now in the carry trade story, one place matters more than most people realize. Japan, when long-term yields move higher. In a country that spent decades living near zero. It's not a small detail, it's a funding shock. Because even small increases in funding costs can crush trades that were designed around almost free money. And when you combine rising yields with a shaky currency relationship, the squeeze gets worse. Borrowers who funded positions in cheap currency now face two problems. Their borrowing costs rise, and repaying can get harder if the exchange rate moves against them. So they do what they always do in a funding squeeze. They unwind, they sell what they bought, they buy back what they sold, and they run for liquidity. Now look at what that means for metals. If some of the pressure on metals came from short selling in paper venues, then an unwind forces buying into those same venues. And forced buying is the worst enemy of a thin market. Especially a thin market, that might not have the physical backing to calm things down. So silver isn't just dealing with demand, it's dealing with the possibility of forced demand, and forced demand is what turns a steady bull market into a violent repricing. Now thread number 3, de-dollarization. Not as a slogan. As a process, you don't need the dollar to vanish. For this to matter, you only need the marginal buyer of US debt to step back. Because the US government runs on borrowing. It spends more than it collects, so it issues bonds, and those bonds must be bought. If foreign buyers reduce participation over time, the funding burden shifts inward. And when the funding burden shifts inward, the central bank becomes more important. And when the central bank becomes more important, monetization becomes more likely. That's not a political statement, it's arithmetic. If you want a simple picture, imagine a restaurant that keeps raising its expenses and keeps promising it'll make it up later. If fewer customers show up, the owner still has to pay the bills. So the owner either cuts spending or finds a way to create money. And governments historically choose the path that keeps the lights on. Now add this to the trust problem we already discussed. If markets see stress in deliveries, and they see rising monetization risk, they stop thinking in terms of growth, they start thinking in terms of preservation. And that shift is what drives hard assets. Now thread number 4, and this is where the story gets dark fast, the strategic lockout. Years ago, there was a retail movement that tried to squeeze silver by buying coins and bars. It made noise. It created a moment, but it didn't fully break the system because it was mostly small buyers. This time the pressure looks different because the big buyers aren't just stackers. They're institutions, manufacturers, and potentially states that view silver as a strategic input. And when strategic buyers show up, they don't care about the premium. They care about continuity of supply. They don't want to win a trade. They want to keep factories running. So they do what retail can't do. They sign supply contracts, they prepay, they buy streams, they buy production, they buy mines, and sometimes they restrict exports or redirect metal internally. And here's the most important part. This can happen quietly. No press conference, no warning. One day the market is tight, the next day the retail market is effectively closed because the available inventory has already been spoken for. That's why people who say it can't happen are underestimating how fast a strategic shortage turns into a policy choice. Now I want to pause and ask you two things, because your answers matter. First, if the system has to choose between keeping retail happy and keeping national supply chains running, who do you think is priority? Second, if a major exchange announces cash settlement instead of metal, do you think that calms the public, or does it light a fire under every other commodity? Drop your answer in the comments, because I read them and I want to know how you're thinking. In our next video on Market Pulse USA, we'll guide you through exactly what to monitor as this situation develops further. All right, now let's talk about what you do with all of this. Because information is useless if it doesn't translate into a plan. The first mistake people make is thinking they can trade a structural reset, like it's a normal market cycle. This isn't a normal market cycle. In a normal cycle, you can sell wait for a dip and buy back in. In a confidence event, the dip might not come in the form you expect. It might come as a gap higher, or it might come as a market that simply doesn't offer product. At any price you recognize, this is why some experienced metals people say, this is the rally you don't sell, not because you'll never take profit, but because the risk of being out when the market locks up is higher than the satisfaction of timing one perfect pullback. If you found this useful, subscribe to Market Pulse USA right now. Drop Market Pulse USA in the comments if you want me to keep pushing this campaign against copycats. And remember, the biggest moves don't announce themselves with fireworks. They announce themselves with shortages, then with excuses, then with policy. And by the time the headlines catch up, the doors are already closing. This is Market Pulse USA. Stay sharp, stay informed, and we'll see you in the next one.